Droughts and other natural disasters can force difficult decisions for livestock producers. In some cases, that may mean selling animals earlier than planned or reducing herd numbers because of damaged pastures, feed shortages, and other recovery challenges. Those decisions can also create tax questions. What qualifies as a weather-related sale? What records need to be kept? And what should producers be discussing with their tax preparers and other advisors as they plan for recovery? Today, we have Tina Barrett joining us. Tina is the Executive Director of the Nebraska Farm Business Incorporated. She works closely with agriculture producers across Nebraska on farm financial management, tax planning, and business decisions. Tina brings practical experience and a strong understanding of the financial issues producers may face after a disaster. She's also an instructor at the University of Nebraska-Lincoln, where she works in the Department of Agricultural Economics and teaches farm taxation, financial analysis, and accounting. Today, she will walk through some tax considerations that come along with weather-related issues, such as livestock sales, including why the reason for the sale matters, what planning options may be available, and how good records can support those decisions. From the Center for Agricultural Profitability at the University of Nebraska-Lincoln, this is Nebraska Farmcast. I'm Morgan Bonifas. Find our farm and ranch management tools and resources on our website, cap.unl.edu.
The general drought conditions that are existing are certainly stressing everyone out for sure. So let's talk today about a few things. So again, we're going to talk about that livestock sale deferral options. We've got two options. We'll cover kind of the basics of both of those. Just a quick reminder on the crop insurance in case there's any crop insurance part of this. And then one thing I haven't talked about in the past much, but comes into play is other general casualty loss situations. And then we'll talk about some other things just to kind of keep in mind with these. So starting with the livestock deferral rules, we have two different rules. So the first one comes from Code Section 451. So that gives us a 1-year deferral of livestock. And then the other one comes from the involuntary conversion rules in 1033. And so that one we a lot of times refer to as the 2-year deferral. So, but that's kind of general because we'll talk about where that's not exactly right either. So let's start with the 1-year deferral. This one allows us to take the excess income from the sale of livestock due to weather conditions, and we can defer that to the next year. So this can be any kind of livestock, doesn't matter what kind of animal that was. If we sold more than we normally would have due to a weather condition, then we can use this as long as we qualify. This one has a few more rules for qualification than the 2-year rule. This one, you have to be a cash basis taxpayer, which makes sense because as an accrual basis taxpayer, you would have an inventory adjustment for it and you wouldn't need to defer it. Your principal business has to be farming. So in the definition of this one, it means like 50% of your income needs to come from farming. So it's a little different definition than being a qualified farmer. And then the area has to be eligible for federal assistance. And so a disaster, like a presidential disaster declaration that comes through FEMA is a slam dunk, no question. Federal assistance, I think, can be a little bit broader than that too if we're getting assistance through FSA due to drought conditions or those kinds of things. I think we can qualify for this deferral in that case too. As we talk about those requirements, it's got to be the sales, again, that exceed your normal business practice. So typically we think about that as a 3-year average of the number of head. So I've got an example here we'll walk through. But so we look at the number of head that you sold for the past 3 years and then compare that to the number of head you sold this year. And the excess that we would have would be what we could defer. So it's not quite like we can just say, I had a calf crop. I normally sell my calf crop in January, and this year I sold them in October. So I have 2 calf checks, and I'm going to take the October check and defer it to next year. Can't do it that way. We have to look at the numbers. And so, but again, we'll look at some examples here and hopefully make a little bit more sense. Again, only the income from those excess sales is deferred. So we can't, kind of pick and choose what kind of number we want to have there. And again, it's only deferred to next year. And so we can't go, 2 years out on this one. It's just the next tax year. When we have breeding livestock that is purchased, it makes it a little bit more complicated because we do need to take into account, some of the other the basis issues. But for the most part, here we'd be able to get on the 1 year deferral, just defer that excess income to the next year, and then calculate that gain as we move on. I mentioned a couple things that we could look at proof of weather conditions. Again, like I said, that presidential disaster declaration is going to be a guarantee all the time. Now, that doesn't have to come before the sale. So if sometime in 26, we would get a disaster declaration in your county or in your area, then that way we could still use that as proof for why we deferred that on the tax return. So again, it doesn't have to come before the sale, it just has to come before we do the tax return. So there are also another place to look would be the IRS's disaster relief notices. So if they have disasters, they're going to post that and recognize those counties. And if you go to their website and search disaster relief notices, you're going to find those, and you can sort that down by state. We're also going to look, at the drought monitor as a proof of weather conditions. And again, FSA, any sort of Secretarial of Ag declarations can also, as long as we've been designated as eligible for assistance from the federal government, those are the kinds of things we'll be looking for. The other option is the 2 year deferral. And again, it lets us defer the gain on the recognition of that livestock sale until we replace the animal. So in this one, it's not going to be feeding and market livestock or poultry. That's specifically excluded. We're talking about draft, dairy, and breeding animals. So those things that we're using in our breeding herd, we can sell those today and have 2 years to replace those animals and not recognize that gain. So it's a little different calculations, but also can be very beneficial, especially in a longer term drought situation where we need to have a little bit more time to where it's feasible to replace those animals. So we don't need a federal disaster declaration for this. All we have to do is be able to prove that there was weather-related conditions for this, and that it's just a much broader definition. So, even you think, having roadside ditches being released for haying, any of those kinds of things that might come. And certainly if the drought monitor shows your county's in a drought, I think that is all we probably need to justify this deferral. So again, you have to have it be your normal business practice to be selling, or that you've sold more than your normal business practice. How about that's probably a better way to put that. It has to be able to say that it was a weather-related condition. So we want to make sure that there is something there in that caused that. So maybe say that there was you sprayed the pastures with the wrong chemical and then killed the grass. That's not a weather-related condition. So that wouldn't be reason why we could defer the sale of the animals. Might fall into a different category, different tax law, but not this one. So again, we're not going to recognize the gain on those animals as long as the purchased animals are replaced within the appropriate time period. And at least to start with this option, we have to have similar use livestock, which means we have to replace beef cows with beef cows, and we have to replace dairy cows with dairy cows. And so those animals have to be similar use in this 2 year window. All right, so let's talk about when this one gets a little confusing. So again, it's a 2 year deferral. That's the general rule that applies to this. But if at the end of that, so that 2 year ends at the end of the tax year following the sale. So if you sold in 26, your deferral goes through 28, and they need to be replaced by then. If you don't replace them, or you only partially replace that money, you use that money, then you got to come back to 26 and amend the return and recognize that gain. Okay, so it gets a little bit dicey or complicated if we have to come back and amend that return to actually recognize that income. We can extend that 2 year period to a 4 year period if the area becomes eligible for federal assistance. So if we go back to that 1 year deferral rules and talk about all those federal assistance opportunities, if you have that, then your 2 year becomes a 4 year deferral. Okay, so still only draft, dairy, and breeding, but our timeline gets extended a little bit more. So that takes that federal disaster declaration. Then It gets even more fun. If we go beyond that 4 years and it's still not feasible, we can extend beyond that as long as the IRS lists that county in a extension area. So every September, the IRS publishes a notice that lists the counties that are experiencing drought based on the drought monitor. And so it's going to give you an automatic extension for that replacement. So we could be into like 2032, and as long as your county still has at least 1 month with a severe drought or more, or it's a D2 severe drought or worse condition, we could still be deferring that sale from 2026. So it can just keep going if the drought continues. That creates a lot of record keeping, not stress, or just making sure that we're remembering that we still have this deferral sitting out there. And so it just kind of, it can get a little crazy, but it is a nice provision if we need it a little bit more than that 4 years to get those animals replaced. I pulled the drought monitor from last week again, so that drought continuing through this part of 2026 makes it looks like most of Nebraska is going to be on that extension notice that's going to come out in September once again. So if we're looking at that continuing drought, so we're looking at deferrals from 22 that we could still have going forward in that extension period. And then again, just a reminder that we have to have that principal business of farming and be cash basis taxpayer for that 1 year deferral. But when we get to the 2 year rules, we don't have that. Those ones are not a problem. And we have all livestock being eligible for that 1 year deferral. And when we look at the 2 year, we're talking draft dairy and breeding livestock only. But in any case, we're looking at those excess sales over normal, which means we need to be able to calculate we need to know how many animals we've sold over the last 3 years, how many we sold this year, and be able to do some of those calculations. And again, the 2 year deferral option doesn't require federal assistance. We just have to have a weather-related condition. The others, we need to have some sort of federal assistance in that area. And then we don't have any replacement property with the 1st year because that's just a dollar deferral. And then the 2 year has to be like kind. We do have a provision that after the 4 years, if it's not feasible still to replace those animals with like kind animals, we can replace them with other business property, but that can't be land. So we could take that deferred income from the sale of cows and put it into a tractor, but we couldn't put that into land. So, and then again, it's important, especially with the 1 year deferral, that we get that tax return filed on time, because we need to make that election with the tax return. That can be with an extension filed. So as long as you file an extension by April 15th and get your tax return filed by October 15th and get the extension filed, you'll be fine. But if you don't file an extension and you file late, then you won't be able to make the election on that return. So I think it's really important as we talk about this too, is that just because we have the option to defer, it doesn't mean it's the best thing for you. Sometimes we're deferring like a really low tax rate, maybe, or if it's a low income year, which probably isn't happening for a lot of cow-calf operators right now, just with the profitability that they've been experiencing for the last couple of years. But everybody's tax situation is really different. And so it makes it really important that we talk to your tax preparer about this and your situation, and just be thinking of potentially things that you can do besides a deferral if we don't need to. The thing that works with this is because raised cows are subject to capital gains rates. And if your income is low enough, that could actually be a 0% tax. So if your income is less than 100,000 and you are selling all raised cows, you're deferring a 0% tax. And then when you go to reinvest that money, you wouldn't have any expense. But if we didn't defer it, then you would have expense later on to deduct, which would offset potentially both self-employment tax and ordinary income tax. So if your income is low, that $100,000 deduction in the future is probably going to get you about the same as that deferral today. So I don't think you need to do it or not do it. Either way, it's not going to change anything. If you have a little bit of income on top of that deferral, so say you have 200,000 of total income and we defer an excess in that year. So if this is 26, that's going to save us about $7,800 to defer that 100,000 of capital gain income. But if we didn't, if we recognize that, paid that $7,800 today, when we reinvest that cows or that money in cows in the future, and we have depreciation expense, and we still have that $200,000 worth of income, then that savings is going to be about 19,000. So in between the two, by paying the tax today and getting the larger deduction later, you'd actually save about 11,000 by not deferring. Okay, so and then you can kind of see how that varies by your income level. So your income level is higher, it's a lesser savings because you're only paying Medicare and not the whole part of Social Security. So again, it gets very complicated, and that's why it's important to make sure you work through your situation with your tax preparer. But I just think it's really important that we pay attention to the fact that sometimes deferring this is actually not going to help you out, and you might be better off to just pay the tax and move on with that. So that situation is a little bit different if we're talking about purchase cows, okay, because those don't qualify for capital gains rates. That's ordinary income. And so the savings in that low area is actually could be backwards to where it is better to defer. And then the savings is definitely less as we go up there. So again, lots of moving pieces in that, lots of different factors that could impact your operation. So it's hard to say what the right choice is. So the other thing to think about, if it just depends on how many dollars we're talking about, but sometimes rather than doing these deferral things, it's easier to handle that extra income in other ways. So if we could do that with some prepaying, and maybe, work those prepaids back over time, maybe making sure we're looking at income averaging and making sure that that's being applied, and maybe because that could potentially absorb a lot of that tax if we have some low income years in the past, and then we're always, questioning those future tax rates. We don't know what's going to happen. We know we have permanent brackets, but that only means until Congress changes something, right? And so if we could be reducing these nice low tax rates that we have today, and then having to recognize that income at a higher rate in the future, not knowing for sure what all is coming. So again, basically, when we're talking about livestock, we've got the two options to make sure we're documenting the federal disaster declarations and or assistance that you're receiving so that we can qualify for those. So, okay, let's switch gears just a second and talk about crop insurance. Again, like that 1-year deferral, you've got to be a cash basis taxpayer. You've got to normally sell more than 50% of your crops in the year following production. The crop insurance has to be paid due to the destruction of crops. So we do have an issue with revenue insurance. And so we want to make sure that we're watching that. If the corn price, for whatever reason, would maybe go in the fall would be like $4, part of that crop insurance payment that you get could be for destruction, but part of it would also be for revenue. And so we would need to pay attention to that as we see what this crop year comes through. And hopefully we don't have to talk about that, and we've got higher prices and we can deal with that. So there isn't any need for any county or disaster declarations or anything like that. If you receive crop insurance for destruction of crop, you're eligible for the deferral. And it is, again, an all or none election. So you cannot split your crops and say that I'm going to defer my wheat payment, but I'm going to recognize my corn payment. If you receive crop insurance, all that would be due to the destruction of crops would have to be deferred if you're going to defer it. So again, just a pretty quick one. That's one we use a lot more, and so we're used to that one. But even as a tax preparer, that just does farm tax returns, it's been a long time since I've made either of those livestock deferral elections, and so it takes a little bit of brushing up anytime we need to use those. Let's talk just a second then and kind of bigger pictures as to what producers need to be doing or thinking about right now. So the biggest thing that we need to do is make sure things get documented. Make sure that we're tracking insurance. We needed to know what livestock was sold when and how many head. I'll talk about some how we're going to keep those records and monitor those disaster declarations. But let's walk through these each individually a little bit here. So documentation is going to be important. Any videos or photos that you can take showing the damage and keep those is going to be really important. We're going to need to know, again, that insurance information, again, per asset. So any settlement statements, any payments that you received, sometimes that gets really difficult because they might pay you a certain percentage up front and then give you the remainder after the repairs or the replacement happens. So you might have multiple payments for each asset. So however you can track all that is really important. It's been a while, but we had this sort of thing happen with several clients that were in an area where a tornado went through probably 10 years ago now. But this was a really time-consuming and really frustrating process to track all that, and try and sort it all out. So it's not a simple thing, but it is a very important part of this. We want to make sure that we're tracking our livestock sales by the type. We always want to do that anyway, but now we need to know how many of each of those were. For most tax returns, we're looking at the dollars sold, but this time we need to know how many were sold. And if we didn't have that in the records from the 3 previous years, we got to go back and figure out how many head were sold in each of those years. And so we've got all of that kind of documentation. We're also going to need to make sure that we're explaining why those sales occurred, and we're saying that was due to drought, it was due to forage loss, it was due to the wildfire and the destruction of the grass. Why did we sell those that was related to that weather event? And then as we start replacing animals, we got to keep track of how many we've bought and how much that was spent. We got to make sure, again, that we're taking the total that we deferred and documenting how we reinvested that. And if we're past the 4 years, what equipment that was reinvested in, and all of those kinds of things. So very important that we have lots of that documentation. As with anything, it's important to separate our business from personal, but here in those losses, we want to make sure that we're really separating that out because those business casualty rules are very different than the personal casualty rules. All right, and then again, start monitoring for those disaster declarations to come so that we can know what you're eligible for and any sort of federal assistance that you're that's up there. I don't think I mentioned it earlier, but I did talk a little bit about your county, but the livestock doesn't have to be in the county that you live in, and the reason for the sale doesn't have to be because the county that the livestock are in is in a disaster area. So maybe it's where your summer pasture was destroyed and you don't have summer pasture now. And so, or maybe you can't buy hay because of the drought or the wildfire. Those would be reasonable reasons that even though the livestock isn't located in the county that was affected, that you could have need to use this. And then I think it's really important that you communicate with your tax preparer early and probably often through this. This is going to take extra work, and it's going to be a lot of calculations and tracking to make sure that all of this is documented well. So the earlier you get them the information means that they could do more of this outside of tax season, which for most tax preparers is a little bit cheaper or a little bit easier for them to do a good job when it's not under the pressure of tax season. So don't wait to talk with them and make a plan for how this is going to go. Anytime we're talking about large losses and deferrals, we've got to really think about how all of that impacts the operation and making sure that we have time to plan around that. So, and again, there's going to be lots of decisions that need to be made. And so, getting that conversation going is really important. And then just a couple things, just making sure that we're not misstepping on this is want to make sure, again, we're got to figure out what that normal livestock sales is. So we've got to go back and again figure out how many head we've been selling on average and use that to make that calculations. Got to make sure we're including those insurance proceeds and making sure we're documenting that as well. All of this is going to take stacks of paper or nicely organized, digital files, however you're going to do this, but we want to make sure we've got all of that information, how it was purchased, how much depreciation was taken, how much insurance proceeds, how much you bought the new stuff for. All of those things is going to be really important. And again, make sure that you file those tax returns on time so that we get those elections made. Otherwise, you're not eligible to make those elections. And we don't want to mix that business and personal losses. The tax treatment there is definitely very different.
Thank you, Tina, for sharing your expertise with us today. If you're interested in learning more, be sure to visit our website, cap.unl.edu.